Imagine just for a second looking at a receipt with this exact number printed at the absolute bottom, $44 billion. I mean, to really put that into perspective, $44 billion is roughly the entire gross domestic product of nations like Iceland or Jordan. It's literally more than the market cap of several legacy automakers. So imagine spending that staggering amount of capital on a single asset and then watching it lose more than half of its value in under 2 years. Well, that's exactly what happened when Elon Musk bought Twitter back in October of 2022. Now, if you just scroll through social media or read the mainstream headlines, almost everyone will tell you this was just a billionaire ego move, right? A vanity purchase that spiraled totally out of control, a massive historic mistake. But what if they're wrong? What if we're actually looking at this entirely the wrong way?
Okay, let's dive into this. Welcome to This Explainer. Today, we are putting away the tabloid headlines, we're ignoring the social media drama, and we're going to look at this strictly as a corporate venture capital case study. We're going to break down the actual anatomy of a leveraged mega deal. We'll look at the raw numbers, the mechanics of the debt, the resulting operational triage, and we're going to tackle the singular question that everyone in the finance and VC world is quietly asking themselves right now. Was $44 billion actually worth it?
Here's our roadmap for making sense of this deal. Number 1, the $44 billion question. 2, dissecting the capital stack. 3, servicing the debt anchor. 4, the valuation collapse. And finally, number 5, the super app venture play.
Section 1. The $44 billion question.
To truly understand the financial mechanics of this leveraged buyout, we really have to look at the sheer velocity of how it all went down. Let's rewind to early 2022. Back in January, Elon Musk started quietly buying up Twitter stock. By April, he owned 9.2% of the company, which abruptly made him the single largest shareholder. Naturally, Twitter's board completely panicked. You see, in corporate venture capital, when a singular entity rapidly accumulates shares like that, it's a textbook precursor to a hostile takeover. The board even seriously considered a poison pill defense, which is a financial strategy designed to just flood the market with new shares, dilute his ownership, and block him from taking control. But instead of a drawn-out hostile battle, Musk drops an absolute bombshell in April. He offers to buy the whole company at $54.20 per share. Total deal value? That massive $44 billion. Twitter accepted. But then, almost immediately, Musk tried to back out. He claimed Twitter had misrepresented the number of bot accounts on their platform. Well, Twitter wasn't having any of it, so they sued him to enforce the contract. After months of intense legal drama, Musk was basically backed into a corner. He had to buy it. And so, on October 27, 2022, he literally walked into Twitter headquarters carrying a physical kitchen sink, posted a video of it, and said, "Let that sink in." The deal was done.
Section 2. Dissecting the capital stack. All right, I want you to shift your mindset here. We're putting on our analyst hats now. Look past the kitchen sink, look past the tweets, because the real story of this acquisition is the math, and specifically, exactly how a deal of this massive magnitude actually comes together. Musk didn't just pull out a checkbook and write a $44 billion check. Nobody does that. The deal was structured using a highly complex capital stack, which is the foundational blueprint of an LBO, or a leveraged buyout. Here's how it breaks down. $21 billion came from Elon Musk and his personal co-investors' equity. Then, $7.1 billion came from outside co-investors. We're talking heavy hitters like Saudi Prince Al Walid and Sequoia Capital. But the crucial piece is that final slice. $13 billion came from bank syndicate loans. Massive institutions like Morgan Stanley and Bank of America funded this huge chunk. And here is the absolute secret to an LBO in the venture world. This is debt taken on by Twitter itself, not Musk personally. You use the asset you're buying to secure the debt you used to buy it. It's essentially a massive, high-stakes mortgage placed squarely on the company's own shoulders.
Section 3. Servicing the debt anchor. The very moment that $13 billion in debt hit Twitter's balance sheet, it stopped being just a number on a spreadsheet. It became a living, breathing mandate that dictates every single operational move the company makes from that day forward. So the absolute crucial point is this number right here, $1.5 billion. Because that $13 billion in debt, it isn't free money. Twitter has to pay interest on it. And this is exactly where macroeconomic timing became an absolute nightmare. A significant portion of this debt utilizes floating interest rates, so the cost to service the loans skyrocketed when global interest rates rapidly rose all throughout 2022 and 2023. We are talking about an estimated $1 billion to $1.5 billion per year in interest payments alone. Break that down, and Twitter must generate well over $100 million in pure cash every single month just to satisfy the banks. And that's before the company can spend a single dollar on engineering or servers or, actual innovation. valuation.
Which brings us to the really harsh reality of the situation. To understand why this debt anchor was so catastrophic, we have to look at Twitter's historical EBITDA. That's earnings before interest, taxes, depreciation, and amortization. Twitter, which is now rebranded as X, was already really struggling to make money before Musk ever even showed up. In 2021, a full year before the acquisition, Twitter lost $221 million. Even in its absolute best, most profitable historical years, Twitter barely generated enough profit to cover a mere fraction of a $1.5 billion interest payment. So try to picture this from a corporate finance perspective. Musk inherited a company that was already bleeding cash. And then, to buy it, he strapped a massive debt anchor around its neck. When you combine pre-existing operational losses with massive new debt service obligations, the math is literally impossible from day one without radical changes. That's not a business, that's a survival challenge. Financial triage became an absolute mathematical necessity.
Let's frame the highly controversial company overhaul through a strictly financial lens, because in distressed, leveraged buyouts, reducing OPEX, or operating expenses, is the absolute first lever that corporate buyout specialists pull. Within 24 hours of taking over, Musk fired the top executives. Then came the mass layoffs. Before the acquisition, Twitter had roughly 7,500 employees. Within months, that number was violently slashed to around 1,500. That's nearly an 80% reduction in headcount. The media obviously covered this as pure chaos, but mathematically, it was a desperate bid to free up cash flow. Twitter was spending way more than it earned, and with the new debt anchor, those OPEX cuts were deemed structurally necessary to just survive. But as we know in corporate venture capital, every action has a reaction. At its peak, Twitter was making around $5 billion a year in ad revenue. Post-acquisition, that dropped by more than 50%.
And here's why that happened. When you cut 80% of your staff, things break. And in Twitter's case, what broke was content moderation. Without proper staff to filter the platform, controversial content, hate speech, and misinformation started spreading much more freely. And this triggered a massive advertiser revolt. Major brands, blue-chip companies like General Motors, Apple, Disney, and Coca-Cola, they paused or completely pulled their advertising. Advertisers simply do not want their highly valuable corporate logos sitting next to toxic content, so they left. Musk tried to pivot, of course. He launched X Premium, a paid subscription model, hoping to replace that ad revenue. But just do the quick math here. At $8 a month, you would need over 26 million paying subscribers just to replace $2.5 billion in lost ad revenue. It simply wasn't enough. A 50% hole in a $5 billion revenue stream, combined with $1.5 billion in new interest payments, that is a devastating combination.
Section 4, the valuation collapse. Given the cratering ad revenue and that suffocating debt, we have to look at what the market currently thinks this massively leveraged buyout is actually worth today. And let's be real, the verdict from Wall Street has been brutal. In 2023, Fidelity, which, remember, was one of the major outside co-investors in the initial deal, marked down the value of its stake by a staggering 65%. If you extrapolate that valuation cut across the whole company, it implies that X was worth somewhere around $15 to $20 billion. Now let's tie that explicitly back to the debt anchor we talked about. In venture capital dynamics, senior bank debt always gets paid back first. So if the company is now only worth around $15 billion and it holds $13 billion in senior debt, the equity is effectively wiped out on paper. Musk's $21 billion and the co-investors' $7.1 billion are currently sitting at a massive hypothetical loss. If we stop the clock right now, today, and judge this deal by traditional financial metrics, Musk significantly overpaid for a struggling business, inherited a failing ad model, and destroyed billions in equity value.
Section 5. The super app venture play.
But look, finance isn't always about right now. We need to look past the current balance sheet and actually examine the long-term thesis behind this move. Because Musk isn't playing a traditional social media game. He's explicitly stated he wants X to become an everything app. The model for this isn't Facebook, it's China's WeChat. The current X platform is largely just text and media sharing, but WeChat is an entire ecosystem. It's payments, it's full-scale banking, it's e-commerce, video, and job hunting, all localized for over 1.3 billion monthly users. Think about the unit economics of WeChat for a second. Taking just a tiny percentage fee on trillions of dollars in peer-to-peer payments completely changes the valuation model compared to a struggling digital ad business. That is the upside of this seemingly terrible deal. The true venture capital play here is to use the existing user base of Twitter as the raw foundation to build a Western equivalent of WeChat.
And that really brings us to the core high-risk, high-reward philosophy of corporate venture capital, as this quote perfectly summarizes. If X becomes even a fraction of what WeChat is, then $44 billion could look like a bargain in 10 years.
In venture capital, investors honestly do not mind striking out 9 times if the 10th hit is a multi-trillion-dollar grand slam. They embrace the risk. If you actually believe that X can successfully evolve into a super app, integrating payments, AI, and comprehensive digital services for 1 billion+ users, then maybe the current financial pain, the 65% markdown, the massive debt payments, maybe all of that is just a painful, necessary chapter in a much bigger growth story. If he pulls off this seemingly impossible pivot, the debt was just temporary growing pains.
So we finally come to the ultimate question. The real debate isn't whether X was worth $44 billion on day one. All the math says it absolutely wasn't. The real question is, will it be worth $100 billion in 2030? Because that answer depends entirely on whether Elon Musk can do what traditional financial analysts say is completely impossible. But then again, Tesla was supposed to go bankrupt, SpaceX was supposed to fail, and yet here we are. So what do you think? After looking at the complex capital stack, the crushing weight of the debt anchor, and the massive upside of the super app vision, is this the biggest financial mistake of his career or the most misunderstood venture investment of the decade? Thank you so much for joining me for this explainer. Keep questioning the numbers, and I'll see you next time.